check in on what the outlook for the fixed income and currency markets is. We've got Mr. Manoj Rani, who's Managing Director and Head of Fixed Income and Treasury for India at BNP Paribas. He joins us on the show. Manoj, to begin with, we've got the borrowings calendar for the first half of the next financial year out later this evening. What are the markets expecting?
I think the market wouldn't be too surprised if it is a little bit front-loaded, because, you know, there are significant amount of inflows in the next month or two. And also there have been certain positive comments from the central bank about liquidity in the immediate future. So I expect market will not be too surprised in the event it's a bit front-loaded.
Sure. So Manoj, to the extent that, everyone's expecting the borrowings to be front-loaded into the first half of the next financial year, should we expect that yields will remain under pressure going forward, at least for some time?
Yes, I would think so. I mean, I think at 840, the 10-year is possibly at a kind of lowish end. And I would not be too surprised if, 850 acts as a kind of pivot and the 10-year moves around somewhere that. So I do not really think there is much of a case for yields to fall sharply, given the fact that, most of the other factors are not supportive of lower yields.
Right, but also, Manoj, you had the Economic Affairs Secretary, Mr. Gopalan, say just last week that the borrowings number stated in the union budget should be viewed as an indicative number, and that the final number could actually be a lot less. There's also talk about the likelihood of the government borrowing something like 20,000 crores less in the first half of the financial year. Is the market somewhere buying that statement coming out from Delhi?
I think there are, the analyst statements are actually contradictory. Just in the aftermath of the budget, most of the analysis which has come out is to the effect that the fiscal estimates seem to be a bit more optimistic rather than realistic. So I think the market will take such statements, in balance with the statements of analysts. So I doubt whether market will read too much into that, at least particularly in terms of running up positions leading to fallen yields.
Just to focus back, Manoj, on the point about the government borrowings, you have the Finance Minister Pranab Mukherjee, who said that the market borrowings this fiscal likely to be at 4.79 lakh crore. That's up from 4.36 lakh crore estimated in the current fiscal. And they did say that, officials are indicating that they are expecting the borrowing to be as per the budget target. Would you concur with this?
I think the best case is possibly it will be as per the budget estimates. Possibly, I think the market is really expecting that there might be an overshoot, given the fact that the fiscal estimates, seem to be a little more optimistic than what people are prepared to swallow.
Sure. And Manoj, just focusing on the interest rate outlook, do you expect some action from the RBI in April? Or do you believe that the market is somewhere beginning to discount the likelihood of a rate hike and beginning to work towards something being done only in June now?
Oh, you mean rate cuts, not rate hike?
Sorry, that's rate hike. I'm sorry, rate cuts.
Yeah. So you're right. I think the market has scaled back its expectations of rate cuts. And I do think that both in terms of timing as well as in terms of magnitude, market is not expecting too much in terms of rate cuts. I, for one, do not expect immediate action either in terms of rate cut or in terms of even a CRR cut in the forthcoming monetary policy.
And how do you believe bond yields will read into the news if there won't be a rate cut from the RBI?
I would tend to think, though, it's always very difficult to predict how markets will react once the monetary policy is behind, because besides the rate cut or, a CRR cut, there are many other factors and signals which market looks at. But I would tend to think that market currently is not in any great expectation of cuts on either side. And I think this is fairly well founded, given the fact that, inflation there are a few concerns relating to food, relating, of course, to the way oil will play out. And, of course, the budget hasn't been very, very useful in terms of diluting fiscal deficit expectations. So I would think market would not take it either too negative, wouldn't take it too negatively if there is no action on the rate or CRR side.
Also, Manoj, how do you see the liquidity picture playing out in the markets? Because On the one hand, you have the RBI talking about the liquidity scene dropping to comfortable levels going forward. On the other hand, you've got the rupee, which has once again come under pressure. There is fear that the RBI will come into the market and intervene. And if that does happen, the ensuing fear then of liquidity conditions tightening once again.
See, I think RBI has, of course, as you just mentioned, has mentioned that liquidity should come down to 70,000 crores. I wouldn't be surprised myself if that happens in the next month or so. And that's given the fact that traditionally you see at the start of the financial year significant amount of inflows both in terms of government spending, transfers to states, as well as seriously large redemptions as well as interest payments on government loans. So to that extent, I think other things being equal, the system should be positively placed as far as liquidity is concerned. Having said that, what you've articulated on the currency side, I think is more symptomatic rather than indicative of what the malaise really is. You can argue out that across the region currencies have depreciated, so to that extent we are not much worse off. Having said that, I think the real critical issue for us remains that we are a significantly large current account deficit country, and given the fact that the rest of our neighbors aren't to that extent current account deficit, we will continue to look for large capital flows, and I do not really see those happening in the next month or two, given the environment prevailing in India at this point of time. So to that extent, I myself am a bit concerned that the positive estimates of liquidity may not actually play out, and liquidity may remain pressured.
And Manoj, what are you penciling in terms of levels that one should watch out for the rupee?
I think, given comments from the economic advisor, as well as not too much of concern articulated by the Reserve Bank, you might see a little bit of upward pressure on the currency, i.e. it may continue to depreciate in the near term, in the absence of fairly large inward inflows. So I would really think that 50 continues to be a base, and we'll really have to see how much it moves up from there. I would personally be quite surprised if it tests 50 and moves below 50 or up above 50, if you may, in terms of appreciation in the forthcoming future.